In handout 2-2, we recorded our transactions as journal entries. The second step in our accounting cycle is to post those journal entries to our general ledger, or to what we'll refer to as an abbreviation as T accounts. So let's begin that process now. In our first transaction, we had a $10,000 debit to cash. And again, debit simply means left. And so we can see we record that as an increase to cash on the left-hand side of our T account. And we had a credit, and the credit is simply the right-hand side of a T account. And we had a $10,000 increase to stockholders' equity. Next, we had a $15,000 debit or increase to cash, and a $15,000 credit or increase to notes payable. Then we had a $20,000 increase or debit to equipment. And in this case, we had a decrease in an asset, a $20,000 credit to cash. Moving on, in transaction D, we had a $300 debit to supplies, and we had a $300 credit to accounts payable. Transaction E, there was no transaction. We simply signed a contract, and again, the transaction will take place when they actually perform the service. Transaction F, we had a increase, a $300 increase to accounts payable. Decrease to accounts payable. We paid our vendor. And we had a $300 decrease to cash. In transaction G, we had a $600 increase or debit to supplies, and a $600 decrease or credit to cash. In H, we had a $1,000 debit to equipment, and a $1,000 credit to cash. And I, there was no transaction. After we've posted all of our journal entries to the T accounts, we want to total up our T accounts. And notice we have $15,000 worth of debits to cash, and we have $21,900 in credits to cash, leaving us with a $3,100 debit balance. We've got a $900 debit balance in supplies, a $21,000 debit balance to equipment. Our accounts payable balance at the end of the period is 0, debits equal credits. We have a $15,000 credit balance to note payable, a $10,000 credit balance to stockholders' equity, and we have nothing happening yet in retained earnings. We'll see that, or transactions that impact retained earnings, in Chapter 3. After we've posted our journal entries to our T accounts, which again show both the debit and credit sides, all the transactions that happened in a particular period, we're going to want to prepare a trial balance, which will show us just the ending balance in all of our accounts. So let's begin. We have a $3,100 debit balance in cash. So we pick up cash. We have $900 in equipment, or supplies. We have $21,000 in equipment. Our notes payable balance, or accounts payable, is 0. We're going to leave it off our trial balance. Notes payable is $15,000. Common stock is $10,000, and retained earnings is 0. One of the things that we hope is that our trial balance will balance, and it should, because all of our journal entries, our debits, equaled our credits. So let's total up the debits. We've got $25,000 in debits and $25,000 in credits. So it's always a good sign. It's important that our trial balance balances. Once we've prepared our trial balance, we'll transfer our balances from our trial balance to our balance sheet, income statement, and other financial statements. Right now we've just got a balance sheet. Let's go ahead and pick up our $3,100 in cash, our $900 in supplies, which means we've got $4,000 in total current assets. And again, current assets are assets we expect to consume during operations or convert to cash within 1 year or one operating cycle, whichever is longer. Basically, we're going to use them up within the next year. All right, we had equipment of $21,000, which means our total assets are $25,000. let's go ahead now and pick up our liabilities and equity. We've got notes payable of $15,000, meaning our current liabilities are $15,000. We've got common stock of $10,000, and we had 0 for retained earnings, giving us total stockholders' equity of $10,000. $10,000 in equity, $15,000 in current liabilities means our stockholders' liability and equity is $25,000. And our balance sheet balances, our total assets equals our total liabilities plus stockholders' equity.